These days, I am seeing people who are calling themselves as value investors, wherein they just look at PE, price to earnings, and PB, price to book, and then invest. They may look at slightly at ROE as well, but these days I am seeing only people mainly concentrating on PE and PB. So the main value trap. So I have discussed a lot of value traps for the so-called value investors, wherein they think it is value investing, but then they get trapped in major value traps. One of such thing which I want to tell here, because I have seen many of my friends or colleagues or then subscribers getting into such traps of investing in cyclical stocks. Cyclical. So cyclical stocks. In the sense, say companies like Tata Steel or steel companies, wherein the requirement peaks at some time and goes low at some time. It is seasonal. So if you are an expert in that, you can participate in that cycle and sell at high levels and buy at lower levels. If you really know about that industry, you will have proper entry and exit. But then if you see major steel players like Tata Steel, wherein if it is at its peak generation or peak profits or peak revenue, then the ROCE will look good, the PE will look good, the book value grows a lot. Then as it is asset heavy companies, they will have a low price to book. So you will think that this return ratios are very good, good ROE, good ROCE, low price to book, low price to earnings, and you are looking and analyzing the company at a juncture wherein the profits have peaked because of the seasonality of the steel industry. So you invest in that company, looking at the so-called valuations. Neither you look at the cash flow, free cash flow, the capex invested, cyclicality of the company, how the company has performed over a period of 10 years, how the profit has been, has there been a consistent free cash flow, consistent earnings, all these things. Without looking at it, just looking at price to earnings and price to book, you invest in the company. Then the seasonality comes, the season wherein the company is unable to generate profit also comes. Then you think that the company is not performing, I have got into a wrong stock, the price to earnings looks so high, stretched valuations, stretched price to book, so you sell the stock. So you buy at the higher level and sell at the lower level. Then the cyclicality comes in and also the earnings catches up, then the valuations become low, the price goes high, but then by that time you would have sold the stock. So this is all about cyclical stock. So never invest in such stocks without understanding the basic principle of this cyclicality. So there are ways and means by which you can invest in this. One way is buying at lower valuation, holding it for a very long time without looking at the cyclical nature of the stock, but then you are requiring the capital invested in a very short duration, say 2 years or something, then cyclical stocks are really not for you. See you next video. Till then, happy investing.